people that haven't read that, haven't heard you talk about it, what is a duck?
A duck is a market that goes sideways, but there's a lot of activity happening under the surface, meaning that if we do see this rotation away from some of the leaders this year, this idea that maybe tech digests some of its recent gains as it hits that peak in valuation, but you do see a recovery in some of these areas that have been left behind, those rotations under the surface could mean that there's lots of opportunity for price changes, but the overall index doesn't move very far, just meaning that we've kind of hit a ceiling on broader valuation, but there's still lots of room for rotation underneath, which is one of the ways that we've been playing this market since the beginning of June, buying equal weight, looking for areas that are trading at discounts in order to take advantage of the rotation. So a duck market seems smooth on the surface, but lots of activity underneath.
Where do the small caps fit into that?
Small caps are still extraordinarily sensitive to interest rates. I think that this is one of the key headwinds for small caps is that they are less profitable. You still have about 45% of companies within the small cap Russell 2000 index still not turning a profit, even in this economic environment. And they tend to have more floating rate debt, which just means that higher interest rates actually bite small caps compared to large cap companies, which have had the opportunity to term out their debt, essentially make them agnostic to current interest rate levels, and really being able to be resilient even in an economy where you see the Fed raising rates so much. So our view on small caps is that you see these pockets and spikes of recovery, but you're unlikely to see a sustained rally and sustained period of outperformance until we start the next cycle, which just means that small caps typically do best at the beginning of an economic cycle when the Fed is easing policy rapidly and they're kind of rebounding from that near death as you went into the recession. So small caps, we think you still have to remain very high quality simply because of high interest rates and that economic sensitivity.
Hey, Cameron, thanks for that. Enjoy the weekend. Let's catch up soon. Cameron Dawson there of New Edge on the latest. Thank you. The broader market about 12 minutes into the session advancing by 0.8% on the S&P. Nice, pretty decent outperformance on the NASDAQ going into a big week for the NASDAQ 100. Some big weightings there for you. Apple and Amazon next Thursday. Up next on this program, the president promoting his economic agenda ahead of next week's jobs report.
There are two parts to Bidenomics. The first part is just explaining what's going on and claiming credit for what is a pretty strong economy, inflation aside, and that's a big aside. The second part about Bidenomics is to talk about some of the president's legislative achievements.
The president heading to Maine to discuss Bidenomics. That conversation up next. We'll catch up with Anne-Marie and Mike McKee.
There are two parts to Bidenomics. The first part is just explaining what's going on and claiming credit for what is a pretty strong economy, inflation aside, and that's a big aside. The second part about Bidenomics is to talk about some of the president's legislative achievements, which collectively amount to this big pro-growth agenda that he got through a divided Congress. So it's both about claiming credit and then explaining sort of the rationale for all the legislations.
Everything's been amazing, inflation aside, as he said. That's a big aside. President Biden preparing to discuss his economic agenda following a string of better-than-expected data. The White House saying this. The president will discuss how Bidenomics is driving a manufacturing boom and helping workers and innovators invent and make more in America. Bloomberg's Anne-Marie has more. Hey, Anne-Marie.
Hey, John. Well, today you can expect a fresh installment of Bidenomics with a focus, as you mentioned, on manufacturing. For the first time in his presidency, the Biden will be heading to Maine. He'll be giving this speech on manufacturing at a factory, and his message is going to be behind those strong economic data points is that his plans are working. One of those points he's likely going to mention today is that investment in manufacturing construction has had its single largest contribution to the nation's economic growth in more than 4 decades. The issue the president is facing, Jonathan, and we talk about this a lot, and actually our reporting is that he's been frustrated with aides around him, is that the message is not landing. The American people are still not feeling that the economy around them, even if the data is showing that it is doing better, that it actually is doing better. They can't feel it. So that's the message the president wants to bring to Maine today. Another interesting point, Jonathan, about this factory, it recently won a legal battle with a Chinese competitor. So broadly, Biden is also potentially going to talk about competition with China and how that plays into his larger economic plan.
Any sign that's resonating with voters, Anne-Marie?
Well, I'm not sure if that's resonating with voters at the moment because we're here from both sides of the aisle that everyone wants to talk tough on China, right, Jonathan? So I think voters get it from all sides when it comes to China. I think it's really going to come down to how people feel about their household income, about their disposable income, about their job and growth prospects when it comes down to November in 2024. I think they're less focused on competition with China and more focused on how much am I paying for groceries and what's the gasoline price today.
And that gasoline price is going the wrong way all over again, more recently anyway.
Yeah.
Anne-Marie, thank you. AMH down in Washington, D.C. That address by the president, 1:15 Eastern time. If you want to pay some attention to that, we will be here at Bloomberg. Looking ahead to next week, a payrolls report just around the corner. Mike McKee back with us for more. Mike, what can we expect?
Well, it's going to be a very busy week, Jonathan. It's the first week of the month, and that's always the week we get the big numbers. We start off with one last day of July, and we get the Senior Loan Officer Survey on Monday. Remember that? The Fed chairman talked about it. He said it's going to come in as expected, so we think there'll be some tightening there. Tuesday, you've got ISM manufacturing and JOLTS. Wednesday's ADP. Thursday, productivity, jobless claims, ISM services, and then Friday is Jobs Day. And in terms of the Jobs Day numbers, we are expecting a slowdown. We've been expecting a slowdown for months and months and months, and it doesn't seem to happen. 190,000 jobs is the forecast at the moment. That'll change as we go through these numbers next week, and economists get a better view of what's happening. But unemployment not supposed to go up, and average hourly earnings supposed to go down just a little bit. So if Joe Biden were giving this speech and we got these numbers a week from now, he'd still have some good news to talk about, and we'll see if that is indeed the case.
I imagine he won't be talking about the ISM Services Index. Mike, Wall Street will be. There is a survey of services activity next week. Mike, Jim Curran of Morgan Stanley was on the program earlier this morning, and he was talking about that divergence, the divide that we talk about, you and I, between manufacturing and services, and he thinks the manufacturing can converge up to services. What are you seeing more recently in those surveys?
Well, what we saw last week or earlier this week, the S&P PMIs, manufacturing did improve a little bit. Services did decline a little bit, but services are still above 50. So if manufacturing moves up to where services are in the ISM version of these PMIs, then it's going to be good news for the economy. And I think we pointed out earlier on the show that goods spending was faster than services spending in the month of June. So maybe things are turning around a little bit.
Very little sign of Fed speak on the calendar, Mike. Have you noticed that?
It's just beginning to fill in. We're going to hear on Monday from Raphael Bostic and later in the week from Tom Barkin. And so I imagine it will pick up, but they're all going to go on vacation. Wait till Jackson Hole. That's when we'll
That's
hear
what we
from
should
a
do,
lot
Mike. We'll take a month off and we'll reconvene.
I'd like that.
Jackson Hole,
you'd talk to the boss about that.
I'd love that too. TK's going to cover. Tom's very adamant about the American philosophy of work and no vacation, so TK's going to be here, taking over things. Mike McKee, thank you. Looking ahead to the Senior Loan Officer Opinion Survey, SLOOS, a sign of its time, really, in many ways. It's like the inflation hysteria of the last couple of years. Hysteria because it was legitimate. Let's be clear about that. But also the fact we were looking at you, Mitch, inflation expectations during that time, and now we're not really. And the Senior Loan Officer Opinion Survey, well, that was all about the bank intention of 2-3 months ago, and now hardly anyone's paying attention to it. It comes out, as Mike indicated, on Monday, by the way. Let's get you some sector price action. We can do that with Abby.
John, we have a very robust day for the S&P 500, the best in basically a month. So not surprisingly, most sectors are higher, led, in fact, by the heavyweight tech sectors, communication services, consumer discretionary, information technology, all up more than 1%. We also have staples, a defensive sector, interestingly enough, up more than 1%. To the downside, energy and healthcare. Energy, of course, dragged on by Chevron and Exxon. As for the week, well, it's going to depend on today. Basically, what today does will determine the S&P 500's direction. So right now, we are looking at a gain. The best sector right there, the communication services index, up 6.5%. It's best week since March 17th, of course, on Alphabet and Meta and those blowout results and the stocks reacting to the upside.
Appy, thank you. Advancing again this morning. Your trading diary up next. The sun is shining on this economy, this market right now, that's for sure. The data's been decent, the earnings have been okay. Chairman Powell appears to give the impression that he's willing to back away. And equities are up by another 0.8% on the S&P. The Nasdaq's positive by 1.5%. Next week, huge week for earnings. We'll talk about that in just a moment. That's the price action. Let's get to the trading diary. President Biden promoting his economic agenda from Maine this afternoon at 1:15 Eastern Time. Then we get ISM manufacturing numbers next Tuesday. More tech earnings from Qualcomm on Wednesday, Apple and Amazon earning results on Thursday, plus ISM services and a Bank of England rate decision coming up a little bit later next week too. And finally, the US payrolls report this time next week on Friday. From New York City, that does it for me. Enjoy the weekend. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Friday, July 28th. Here are the top market stories we are following for you at this hour. Curveball. The BOJ makes the surprise move on curve control by loosening its grip on bond yields, jolting markets in the process. The Japanese 10-year yield hits the highest since 2014. Intel in the clear. Shares surge after the chipmaker delivers an unexpected profit, gives a bullish forecast, and declares an end to the PC slump. And mind the data. PCE data shows cooling in inflation while consumer spending picks up. UMich consumer sentiment figures are dropping now. From Washington, I'm Kaylee Lyons with my co-hosts in London, Danny Berger, Alex Steele, and Guy Johnson are off today. Welcome to Bloomberg Markets. Danny, happy Friday. And as I mentioned, we have some data to get to.
Happy Friday, Kaylee. That's right. As you say, UMich numbers coming in. This is the final reading, and we're seeing some slight tweaks to the preliminary reading. Not massive. Maybe the one to look out for is 5 to 10-year inflation that has been revised slightly, and it was at 3.1%, Kaylee. It's now just at 3%. Otherwise, sentiment, both expectations and current conditions have come in. Sentiment was at 72.6 at 71.6. So inflation comes in a little bit, Kaylee, but so do expectations. Perhaps good news for the Fed?
Yeah, maybe. It certainly doesn't seem like it's good or bad news for the market at this point. Not seeing too much reaction in Treasury yields. Right now, the 10-year yield is down by just about 3 basis points. Of course, though, we have seen Treasuries whipsawed in the last 24 hours by news out of Japan. First, the Nikkei report that the BOJ was considering a tweak to curve control, and then the Bank of Japan actually did it. It does look posed to be making changes to its yield curve control program, which, of course, it first introduced in 2016. We can see here the reaction on Japanese bond yields, that big jump in the 10-year GGB after they announced they would allow it to rise above that 0.5% level. Joining us now for more is Bloomberg's Enda Curran. So, Enda, can we call this a shock? Is it a shock? Or was it a shock yesterday when the Nikkei report came out?
Definitely a surprise anyway. Markets seem to have recovered a bit on it this morning. Look, they are effectively doubling this yield band that they have been pursuing over recent years. But the bigger story, leaving aside the technicalities, is that they are trying now to move away from this program of yield curve control. It has outlived its purpose. Japan is obviously moving on. They're dealing with inflation at the moment, for example. Governor Ueda is trying to stress it's not a tightening. He doesn't want to exit the supportive policies that he have, but it's going to be harder to sell that message now, and it's expected he will really exit this over the coming months.
Right. I find it quite remarkable that the market quickly moved on to focus on other things, focus on, barely softer PCE data we had this morning. Is it job well done then? I'm assuming Ueda didn't want to cause any sort of market rupture today, and
Exactly, Danny. He really wants to take this carefully. But you saw the initial reaction when the Nikkei news came out. People were quite surprised by it, and you saw the response. But I think the BOJ will be comfortable with where they're at. They know they need to take this very carefully. Governor Ueda has said several times he doesn't want to trigger big financial market volatility in Japan. Remember, Japanese investors, they're big buyers of U.S. government bonds, big buyers of securities and real assets right around the world. And the idea is if Japanese yields were starting to go higher, well, they might start to pull some of that money home back to Japan. And of course, that would have an impact on the cost of borrowing around the rest of the globe as well. So the BOJ is taking this carefully. They have to take it carefully. But you'd have to say that they seem to be on a one-way path now when it comes to YCC.
Yeah, it does, though, feel like the market's trying to be careful. No one wants to sell above 50 basis points because there's a whale, the government of Japan, that could come in and run you over. Enda, thank you so much. That's Bloomberg's Enda Curran. And this debate as to how big of a deal exactly it is that the BOJ is now defending the ban differently brings us to our question of the day. Is this a tweak or a tide change? Joining us now to discuss is Apollo Global Management Chief Economist Torsten Slok. Torsten, what do you say? How big is this? Is it a tweak or a tide change?
It is a tide change. The train has left the station now. It's very clear that the signal that the BOJ is sending here is that they are going to allow JGB yields to move higher. And this does have important implications because Japan is the biggest holder in the world of U.S. treasuries. They own more than $1 trillion of U.S. government bonds. And that is, of course, the risk looking ahead that if we are going to see an asset allocation change where Japanese investors will begin to take money home from U.S. fixed income markets to their own backyard in JGBs where yield levels are now higher, that will, over the coming months ahead, likely have some implications for, in particular, U.S. rates.
Well, Torsten, good morning. As we were just hearing from Enda and as we heard from the governor himself overnight, he was trying to indicate this is not tightening, this isn't even really normalization. What does the path toward actual normalization look like now, going forward, now that they've made this tweak, if it is indeed a tide change, as you say?
Yeah, no, and that's important, and it makes sense, of course, that when you've had a policy in place since 2016, where essentially the BOJ has been trying to keep JGB yields at very, very low levels and have successfully kept JGB yields at very low levels. It has come at the cost of very significant interventions. Japan, in this case, the Bank of Japan owns more than 50% of all JGBs outstanding. So in some sense, it was unsustainable to continue yield curve control. So it's not only because inflation is very high that is the reason for this tweak or change. It is also that there's very little liquidity in JGB markets, and their ownership had gotten up to very high levels compared to other central banks. And because of that, one step at a time, but the clear issue here is that that step is certainly in the direction of allowing JGB yields to move higher.
Are we going to look back at this, Torsten, and say this was a very elegant way to exit YCC, to kind of smooth out the upward trajectory instead of having any pop in yields?
Yeah, so at least widening one step at a time is probably the best approach that you can have. But let's think about it from the broader perspective. I mean, inflation has gone up globally. The Fed has raised rates, the ECB has raised rates, Bank of Canada, Australia, the Bank of England, everyone has raised rates. The Bank of Japan has done very little. In fact, today is the first move that we're seeing in response to high inflation. So if that's the case, then from that perspective, the Bank of Japan is just following along what other central banks are doing. So to your good question about how is this going to be viewed, if we look at it from a longer term perspective, this will likely be viewed as a major day in US and Japanese fixed income markets, because it does signal the end of the 7 years where yield curve control has been in place. And yes, we may get more widening further out, but the consequences are clear that Japanese investors will now be looking, and they already have expensive hedging costs for when they buy US fixed income, but when they roll these hedges, then they will probably be looking at US fixed income with different eyes now that yields in JGB markets will be going higher.
Okay, so if that is happening simultaneously, Torsten, with potentially the last hike of the rate hiking cycle for the Fed in the rear view, in theory, they haven't indicated that they are going to go in September. How did those two forces collide, that Japan is doing this while the Fed is slowing things down in a material way?
Yeah, it's a really important question because, I mean, think about it. The Fed is trying to tighten financial conditions. They are doing that by raising rates. That has been countered by a bull run in equities and in credit. So that has been easing financial conditions and therefore offsetting what's been happening with the Fed funds rate. So interestingly enough, what has been happening here with exiting yield curve control, or at least widening the band, is indeed a tightening in financial conditions that therefore actually helps the Fed in this process of trying to slow the economy down with the ultimate goal of slowing inflation down. So yes, it is a collision of forces that's very important. The question is, of course, how manageable and how much this will be over time. And if we do see over the weeks ahead still more drifting higher in long rates, then that will, of course, help the Fed's goal of trying to slow the economy and ultimately slow inflation down. But that's why it's so difficult to exit a policy that you had for 7 years in an easy and smooth and gradual way. So let's see where this goes. But for now, it's, of course, pretty clear that it's been pretty volatile over the last 24 hours.
Especially a policy that's forced you to own half of the bond market, Torsten. They also downgraded their 2024 inflation expectation to below the target of 2%. Do you buy that? Do you think Japan will be there in 2024?
Well, a lot of that also depends on a number of different things. Of course, global growth and importantly also what will happen to the yen. Interestingly enough, of course, as you know, that if you do see Japanese yields go up, that will then attract more money into Japan, which will create a yen appreciation. And an appreciation in the yen is holding down Japanese inflation. So therefore, exiting yield curve control is actually helping the BOJ in terms of putting downward pressure on inflation through import prices or through the yen appreciating. So I do think that we will see now some impact on Japanese economic activity, and we should also expect to see some impact on Japanese inflation. But the magnitude of this, and likewise, like the debate we have in the US, can this be done in a smooth way where we get a smooth landing or soft landing, or will this also run the risk that we get a harder landing because yields just simply go up too much and they have to intervene again when we get up to now the upper end of this new band? It will be a very exciting time ahead of us for currencies and for fixed income because it has so many unknown factors in terms of what would the response be, in particular of big investors in Japan, to seeing yields in their own backyard start to move higher.
All right, just when I thought things were exciting enough. Torsten Slok of Apollo, thank you so much for joining us. Have a great weekend. Coming up, we're going to get more on this question of the day. Torsten thinks it's a tide change. Is it, or is it a tweak? Kristen McLeod of Barclays will join us next with her take. This is Bloomberg.
The Bank of Japan are tinkerers in this, and he seems like a willing to tinker at the margin, sort of a football coach who changes his team every game and or formations twice in a game, you know, can't leave it alone. And that's not necessarily a bad thing. I think to say that you're unpredictable, yeah, the market says he's pretty clear in his communications.
That was Kit Juke, SocGen Chief FX Strategist, speaking earlier to Danny on Bloomberg Television, which brings us back to our question of the day. The BOJ's move overnight, was it a tweak or a tide change? Joining us now is Kristen McLeod, Barclays co-head of Global FX Distribution and head of America's Macro Distribution. So, Kristen, what do you think? What exactly did the BOJ do here?
Well, I think the BOJ wants us to think it's a tweak. But the reality is there's little doubt that this is the first step towards policy normalization. If we take a step back, I think, you know, this has been a stunning turn of events. By most measures, the communication that we've heard from the BOJ, from sources, from officials over the past month, in many respects has been stubbornly dovish. You know, there was a firm signal that change was not imminent. As recently as last Friday, we had that article out suggesting that there was no change this week. So when the headlines hit yesterday, this obviously caught the market by surprise. And I think the price action that you're seeing both overnight and today is, again, emblematic of that. The yen strengthened, you know, close to 2% yesterday. Again, almost 4% on the month. And again, a lot of that was this YCC premium in the market, the way that the market had priced the currency leading into the event.
Why not test it even more, though? We say, okay, UA wants us to think it's a tweak. Why not treat it, though, like it is a change? Why not send JGBs to 1%? Why not continue on with the strength of the yen?
Look, I think they've been pretty clear that they don't want to see this type of volatility in the market, and they don't want to announce that kind of dramatic move. When you think about the way that the currency has traded so far this year, anytime we kind of, traded up towards that 145 level in dollar yen in particular, there was verbal intervention. There was a lot of pushback, again, on the volatility of the currency. So again, I think the way that they rolled out this announcement was with that goal that they can make this slight adjustment now, and that kind of eases the path for future policy change.
Okay, so when we're talking about the path for a future policy change, how far away realistically are we from that moment, Kristen, toward normal or the start of normalization?
So at this point, our call is looking for a complete scrap of YCC at the October meeting. Again, that is still a fairly far point away from actually taking rates into positive territory. So our base case right now is that they abandon YCC at the October meeting, they take rates to 0 in April of next year, and then they start hiking at that point.
Kristen, I'm getting some very serious whiplash, not just from the yen, but really the euro. I was very ready, and perhaps prematurely was ready to declare the death of the strength of the euro, but it's stronger today. It's even stronger against the yen by more than 1%. What do you make of that type of volatile price action we've seen on a week of the ECB?
This has been a really interesting week for currencies. And again, I think yesterday when you saw the euro under pressure, it was really this perfect storm. You were coming out of a more hawkish Fed on Wednesday. You came into a clearly more dovish ECB message on Thursday. Again, while they're leaving the door open for future hikes, our call is actually that this was indeed the last hike of the cycle. And then you had this announcement and the leak yesterday, and then again the confirmation of the YCC tweak from the BOJ. So I think again, when you think about the euro and you think about the future path of the euro, we see fair value somewhere around that 113 level. The reality is, again, the economy has been weaker. The risks of recession clearly are increasing. And we've said for a long time that really for the euro to kind of move beyond that, you'd either need to see a sustained pickup in global growth that would put the dollar on the back foot, or you would need to see a large reallocation out of U.S. assets into European assets.
Okay, I'm looking at euro dollar that's at 110 right now, so you think there is a little bit more room to strengthen there. I just wonder on the dollar part of that equation, given as you're talking about the deterioration in European data with the GDP print we saw yesterday, with what we're seeing in personal spending as inflation cools, what does that mean for the dollar if all the signs seem to be pointing, at least right now, to a soft landing in the U.S.?
Look, the U.S. economy continues to go from strength to strength. And I think, again, when you look at the activity data over the last handful of weeks and months, it continues to surprise to the upside. Obviously, Powell, leaned hawkish this week. I think he was very deliberate to not say anything that would allow the market to interpret as dovish. And it's very clear that he's still, leaving the door open for another hike. Our base case is that we see another hike later this year, most likely November. That will be peak rates. And again, we are pushing back against the idea that the Fed could start cutting as early as first quarter of next year. And I think Powell was very deliberate in his words around this when he said the committee will review potential cuts a full year from now. So when I think about what that means for the dollar, again, when I was on this show a week and a half ago, the dollar was under pressure. It was right after that softer CPI print. And I made the argument that the market was too quick to extrapolate out this trend, that this softer CPI print was going to be sustained. And I think Powell acknowledged exactly that at the meeting this week. So again, while the dollar is probably close to its peak as we're nearing peak Fed, this narrative around a broader dollar demise is likely premature as well.
Wait, so then how do we get to 113 on the euro? I realize that's a small move from where we're at 110, but if Europe is starting to look weaker, maybe the Fed has a little bit more juice, what's the trajectory look like?
Look, there's obviously a lot of focus on China right now. And again, a big reason of why Europe hasn't hit some of its growth projections that we were talking about earlier in the year is because that China reopening story was weaker and disappointing to the market. I think a lot of that is priced in at this point. And if you do get surprise in stimulus or surprise in policy support out of China, that could certainly reignite some of the global growth outlook, and that would certainly be beneficial for Europe and the euro.
All right, China, the saving grace of the euro. Kristen, thank you so much for joining. Really appreciate your time. Kristen McLeod, Barclays co-head of Global FX Distribution and head of America's Macro Distribution. Still ahead, Intel surges after PC recovery delivers a surprise profit. We're going to have details in the startup next. This is Bloomberg.
Great questions.
It is 7:22 on the West Coast, so let's get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now is Bloomberg Technology co-host Ed Ledlow. And Ed, what a morning it is for Intel, up about 5%. The PC slump over, they've declared it, it's done?
They've declared it, it's done. I mean, there's a lot of weight on the outlook for the current period. Sales of $13.8 billion, which is only like modestly ahead of the $13.3 billion that the sell side was forecasting. But the story is that the inventories that PC makers were working through, that's complete, and they're now starting to order chips. And, I love earnings season because Gelsinger, the CEO of Intel, did say, last quarter before, that they saw improvement into the second half of this year. And what they did in the earnings print overnight and on the call was say, actually, yeah, that is happening. It's true. Orders are coming in, but it's uneven. The server business isn't seeing the same pace of recovery, and Intel's kind of missed the boat a little bit on AI.
I was going to say we've seen their rivals like AMD, NVIDIA surge this year. So can they catch up at this point, or is it they're just too behind as it stands?
Yeah, so look, when we talk about investments into AI chips, what we're largely talking about is high-powered GPUs. The GPUs go into server banks or clusters that go into data centers, right? And NVIDIA's been the main beneficiary of that. Intel offers similar products, Gaudi. There's also CPU and memory requirements when it comes to to chips that are used in the training and then inference side of LLMs. But the admission from Gelsinger was that all the cloud spend has been very concentrated. In other words, it went to NVIDIA, and they've not seen any of it. Now, as time elapses, Gelsinger's argument is that there'll be requirements for a broader set of chips, and Intel can benefit when there are lower processing requirements, people want access to lower cost chips, and Intel can offer those products.
So as I said, Intel seems to be doing pretty well today, but that's really a largely tech story. In the NASDAQ 100, there's only 9 stocks that are down at the moment. 91 are higher. Microsoft, Apple, Amazon, Meta, Tesla, all of them are in the green. What do we attribute this to?
Like, it's Friday. This is the start. I want to come on the show and talk about tech.
Thank
I want to
God.
talk about artificial intelligence. And yet the market is trading on economic data and fundamentals, and you read Alex Barinka's Tech Daily newsletter, and all the executives at Microsoft, Meta, and Alphabet wanted to talk about was AI. What the market is buying shares on is that their core businesses, advertising in the case of Alphabet and Meta, and then software and cloud in the case of Microsoft, they performed well in the quarter's gone. Boring. GDP 24 hours ago, ticking up unexpectedly in the quarter gone. Great. No recession. The Fed speak. These are companies that have strong market positions, entrenched market positions, strong balance sheet, and they are also performing in their core businesses. And I think the market's looking at that. Oh, happy Friday.
Ed, I mean, do you think that some of these executives will face a sense of frustration if macro reinserts itself as the driver of tech? We got about a minute left here.
It's why I'm looking forward to Apple, because Tim Cook has said in prior calls, I am not an economist, and yet that is what he gets asked quarter after quarter. But you get a good sense of geographic breakdown of consumer health, because Apple is a higher end product. You think about China as being such a key market, the price point that they're coming in at. So you learn a lot about the economy, but I bet you they'll talk a little about AI. And then you have Amazon as well. Prime Day's been and gone. It won't be included in the quarter-day report, but you get a good barometer of the health of the US consumer.
I was going to say, Tim Cook has some data that gives you a read on the economic economy that I think economists would probably sell their cousins and their mothers for.
Right.
Ed, thanks so much. Bloomberg's Ed Ludlow there. He'll, of course, be back for Bloomberg Tech with the CEO of Intel.
We are an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves. And Abigail, looks like risk appetite is on this Friday.
It certainly is. We have a risk-on mood this Friday in a big way, Kaylee. We have the major indexes here in the U.S. trading up about 1% or more, especially for those tech-heavy indexes. We have big gains. As far as the S&P 500, as today goes, so shall the week go, essentially. So we're looking at a third up week for the S&P 500. Now, on the week, take a look at the dollar-yen into today, down. But on the yield curve control, we have a little bit of a move higher, a little bit of a recovery, but still down on the week, which is an interesting one to take into account in terms of different factors, which could come into play in the future in terms of no longer using the yen as a carry trade, but we'll just stick with this right now. But one thing we do know is it means the Bloomberg Dollar Index is higher on the day, or excuse me, lower on the day, down about 0.3%. But take a look at gold and palladium benefiting from that, in particular. Commodities overall up about 0.3%, but some of these metals a little bit more sensitive to the dollar moves and getting a bit of a bid. And then finally, we of course have so many tech earnings. Today we had Intel, great quarter there, and the outlook rate recovery for PCs. But clearly, Danny, the takeaway ones, or the big ones on the week, Meta and Alphabet, both up almost 10% on the week, or about 10% on the week. And it seems as though there really is a recovery for ad sales, driving both of these companies higher. Alphabet on the week into this up about 38%. Meta on the week into this up about 150%. So maybe Google, Alphabet, that's where the catch-up trade could be in the weeks ahead.
From strength to strength. I will say, though, it's incredible to see a company like Meta lose some of its steam yesterday from the Bank of Japan. Who would have thought? Abby, thanks so much. That's Bloomberg's Abigail Doolittle. Now, a lot of data to sort through. We got some evidence of the strength of the U.S. consumer from earlier data. Personal spending came in stronger than expected. For more, let's bring in Sophia Baig, Morning Consult economist. Sophia, the last reading was 0%. Personal spending comes in higher by 0.5%, also income. When you look at both of those, what does that say to you? That the soft landing is on its way, or that the Fed has much more work to do?
Thanks for having me. Real personal spending grew at its fastest pace since January last month in June, which reinforces the picture painted by yesterday's GDP report, painting a picture of a resilient U.S. consumer despite climbing interest rates and everything else that's going on. This, with slower inflation, growing real incomes, have provided some breathing room for consumers, and we see them spending on things like travel and recreational activities as the summer season heats up. We may see the momentum begin to fade as summer splurges dry up, and Morning Consult data suggests consumers are growing increasingly price sensitive, and they're becoming more sensitive to prices. So it's possible that the spending slows down because these high prices have been going on for a while, but right now it's positive.
Well, Sophia, when we talk about this resilient U.S. consumer, what kind of consumer realistically are we talking about? What differences might we be seeing at the higher end and the lower end? I just wonder if there's more under the surface going on than meets the eye.
You're very correct. So at Morning Consult, we pull the average consumer, and so we can dig into a demographic level. When we look at the demographics, it's a bit different than the overall picture. So PCE is measuring the spending of the whole economy, whereas we can see how the average consumer is spending. What we're seeing in our data is that high and middle income consumers, especially those high income consumers, are the ones who are really propping up spending in the past couple of months. They're spending on things that are related to vacations, like hotels and airfare, recreation, apparel to get outfits for their summer vacations, and they seem to be driving a lot of this spending. So while it's good news that spending is coming in strong, and it looks like we might be heading towards a soft landing, because these are the signs that we would have if we had a soft landing, it is kind of in these discretionary seasonal categories that are more easy come, easy go, and it's more it's concentrated in the higher income groups.
How does the Fed rein that in when its tool is a sledgehammer, when its tool has been used to the extent of 500 basis points? It doesn't feel like that's going to change someone who's on the wealthier side from going to a hotel. I mean, how does policy get transmitted specifically to this issue of a robust consumer?
Great question. So the Fed has been raising rates really rapidly. So part of it is just letting time run its course and let those high rates feed down to the rest of the economy, because it hasn't been that much time. They've raised rates fast historically. And then the other way that we can slow down these high consumer spenders is by thinking about how high consumers spend. So they're spending on these more recreational activities, and yes, they're spending a lot of money, but the way that the Fed can target it is by slowing down the economy as a whole, and real incomes are coming down. That excess savings that's been accumulating over the pandemic has drained down quite a bit. So we may see them start to run out of steam because some of these savings are draining down.
Mm-hmm. So as we talk about the tools that the Fed has as it's trying to get to its 2% target, I wonder if this is the most difficult part of the journey, that they've gotten it down to 3%, but that 3% to 2% leg is actually going to be the hardest to achieve.
Yeah, that's very true. So from 3 to 2% might be a lot more difficult. So part of it is that some of the surveys that they've done on inflation expectations has shown that consumers are expecting inflation to remain at that 3% level. So it may be a lot harder to get down to 2%. Additionally, the spending levels are strong, and high income and middle income consumers continue to prop up the economy. In order to get it down to 2%, the Fed may need to continue raising rates. They've emphasized at this last meeting that they're relatively hawkish. They're willing to do anything possible to get it down to 2%. So even though we're seeing signs of a soft landing now, if they raise rates, we may reach a breaking point where the economy starts to slow down in order to get it down to that 2%. So people could be underestimating how much it takes to get from 3% to 2% because of what it might take from the Fed to get it there.
So maybe the hiking cycle isn't quite yet over yet. Sophia Begg, Morning Consult economist, thank you so much for joining us. Now, coming up, we're going to take a look at how the rate environment is affecting the steel industry. We'll have an exclusive interview with David Burritt, CEO of U.S. Steel, on their latest results. This is Bloomberg. Shares of U.S. Steel are down despite profit and sales beats for the second quarter. Natalia Knievich breaks down the results for us. Natalia?
The company posted really strong results for this quarter. EPS, net sales, and adjusted net income all beat estimates. But if we look at a bigger picture, if we compare the results to last year, we see that net sales are down by 20% and adjusted net income is down 56% year over year. So to understand what's happening with the company, we have to take a step back and look at what's going on with steel prices. We see lots of volatility here. So prices were extremely high during the 2021 and 2022. That's because the global economy was trying to recover from the pandemic. Global governments provided stimulus. We had supply chain issues. And in 2022, there was a concern that Russia, also one of the biggest steel producers, wouldn't be able to supply steel globally. But it didn't materialize. Supply chains kind of got back to normal, and now prices are moving lower. And one of the reasons for that is also investors and the industry is really concerned about the global recession. So what do people do who trade commodities? They see better returns in commodity ETFs. So let's take a look at steel ETF. It is now trading at a multi-year high. But keep in mind that two of its biggest holdings are Valley and Rio Tinto, which are not actually steel companies, but more companies that are in mining and metals industry. So the biggest question, Kelly, for investors is what happens with the steel demand in 2023, because now China is hinting that it will provide more stimulus, and this is one of the biggest upside surprises for the industry.
Natalia, thank you so much. That's Natalia Knievich there. And for more on this, let's bring in David Burritt, U.S. Steel CEO, who joins us now for an exclusive interview. David, thanks so much for joining us this morning. Look, we probably have to start by what seems to be the mood on Wall Street in reaction to your earnings, potentially on your third quarter look ahead. It is more conservative than peers. What do you think accounts for that? Why you see a bit of a softer outlook than some of the rest of the industry?
Well, thanks for having me. It's a privilege to be able to spend some time with you here today. First, I have to say 11 consecutive quarters of profitability, so we're clearly on a nice run here, and I'd be remiss if I didn't thank our employees who've worked so hard to please customers, who ultimately will those improvements will be recognized by our stockholders. And the things we care about, generating cash, serving our customers, and have to say all-time best safety results. So for the 22,000 employees that are here, they've done an incredible job taking care of safety first. But as far as the trends for us, short-term vagaries of the market, they will happen. You go up, you go down. But I have to say, I couldn't be more bullish on the United States. I couldn't be more bullish on the steel industry, and I couldn't be more bullish on United States Steel. Bumps in the road for sure, but longer term, the future is incredibly bright.
Well, David, it's Kaylee coming to you from Washington. When you say you're bullish on the United States, how much of that is because of infrastructure spending, the Inflation Reduction Act policy we have seen emanating out of Washington?
You put your finger right in it. When we hear Inflation Reduction Act, we think it's time to rename that. It's a Manufacturing Renaissance Act. This is the most incredible thing that we've seen in the United States for a very long time. It's fantastic to see that our country finally recognizes how important a strong manufacturing base is. It may have taken the pandemic, it may have taken some real hardships for a lot of people, for businesses and people to understand how fragile the global supply chain is. But for us, this plays to our strength. Mine melted and made in the good old USA. Deglobalization is real, and there's a lot more onshoring. The good news for us is we're welcoming people back, but we never left.
You mentioned this in your earnings call, too, that it's a matter of national security to have a strong at-home manufacturing sector. David, can you just lay out why that is? Because obviously it's something the government is looking at, too. How do you see the geopolitics playing in to bringing it home?
Well, I think both parties, this is one of those bipartisan things on trade. They fully understand how important manufacturing now is to the United States of America. And if you look at just the challenges that we had during the pandemic where we couldn't get basic things, the auto industry suffered greatly. The appliance industry, virtually every industry that we serve struggled because they couldn't get parts from other parts of the world due to the pandemic. So we know we have to reshore, and we have to be self-sufficient. We have to be resilient. That doesn't mean we can't have partners, but we need to be able to do things here first. And with the strong trade actions that with 232 that came into place in March, and now we got fantastic support from the administration with Representative Tai and Secretary Raimondo. They're hitting it out of the park in terms of making sure that we can have an extremely strong and resilient manufacturing base in the USA.
Okay, so we've talked about the U.S. quite a bit now, David. What about Europe? How is what you're seeing in these different markets different?
Well, we have operations in Europe. In fact, in Slovakia, it's an exceptionally run facility, but it's been challenged because it's just 60 kilometers or about 40 miles away from Ukraine, and they've been doing great help to the people that have been so disadvantaged by such a horrible tragedy that's happened over there. But Europe is more challenged than what the United States is. In fact, they've got greater GHG greenhouse gas emission challenges in Europe with steel than what we have in the United States. So Europe's a more difficult environment for sure to operate, but we're finding our way through that in our large operation. We have about 8,000 people there that are serving customers the best they can in this difficult environment, and still being able to be earnings EBITDA positive.
And of course, your European operation used to source some materials from Ukraine, from Russia. You've had to look for other places to develop new sources. Does that long-term hurt profitability?
Well, over time, we find ways to be more resilient. Over time, we find ways to resource. And again, great lesson learned. We need to be more resilient here in the United States. Wherever you live and work, you need to make sure you can function, you have the resources to be effective. If you're always relying on other people and other places, other suppliers, it's not going to be as secure than if you can do most of those things yourself.
And finally, when we're talking about U.S. Steel's business, obviously following your acquisition of Big River Steel, what does the balancing look like, non-union Big River Steel, with the rest of your steel operations?
Well, we're pursuing a strategy we call best of both, ultimately best for all, for profitable steel solutions for our people and our most important customer, the planet. But we have the integrated mills and we have the mini mills. The integrated mills have mining assets, iron ore, that we, in effect, I like to say, digging it out of the dirt, where the mini mill assets are highly efficient, built for speed and recycling. What we're doing is pulling those things together. Today, in terms of representation, our integrated mills are represented by the USW, and the mini mill in Osceola, Arkansas is independent.
Hey, David, I'm afraid that's all we have time for. Thank you so much for joining us today. David Burritt there, U.S. Steel CEO, in a very patriotic mood. All right, coming up, there's an exodus of talent at Goldman Sachs. We're going to look at what that means for CEO David Solomon's strategy. That's today on the Wall Street Beat. Next, this is Bloomberg.
time now for Wall Street Beat, where we look at what is buzzing on Wall Street in the world of banking and finance. And today, we're looking at how Goldman Sachs is struggling to hold on to its top talent. Joining us now is Bloomberg's Sonali Basak. So Sonali, let's speak about one talented individual in particular, Julian Salisbury. His departure, how significant is it?
It's quite significant because Julian Salisbury was the CIO of the $2.7 trillion asset management giant within Goldman Sachs. Remember, Goldman, this is the big money bet now. After consumer, they are doubling down on asset and wealth management. And this was a very key leader in that business that has only had his star rising over at Goldman. Now remember, he is joining now Sixth Street, which is about $65 billion in assets. It is a private asset giant here that has only been growing and has also been started by a former Goldman partner, but other Goldman talent on board, including Marty Chavez, the former CFO at Goldman, who is also a partner there, been hired just 2 years ago. So certainly a big move in talent here and a significant person to be leaving Goldman at this particular time.
Well, even just Sixth Street itself, Sonali, that all the names you said there, that's a lot of people from Goldman, and it's, of course, not the only string of exits they've had. How big of a problem is this for the bank?
Yeah, the people I had named that had moved to Sixth Street, for example, they moved kind of a long time ago, but the more recent moves are very notable. If you think about Katie Koch, who was a very significant executive running the public equities portfolio over at Goldman Sachs, this year she joined TCW as CEO. Margaret Anadu, a key part of their sustainability strategy, had left and joined Vistria. More recently also, and this one was a massive name as well, Dina Powell had left and she joined MSD. So you're seeing a lot of movement of very, very well-known names, some of which had been at Goldman for decades, had started their careers there in some cases and rose to the very, very top. Now listen, Goldman has had turnover like this for a while, and it doesn't mean that the new leaders don't just pop right up. But again, it is happening at a sensitive time and a key time for the money manager.
Yeah. Well, and as we talk about these departures, Sonali, it's not that they're moving from Goldman to Morgan Stanley or JP Morgan or another Wall Street kind of rival traditional bank. A lot of them are going to non-banks.
What's fascinating about that, Kaylee, is that, yes, Morgan Stanley, JP Morgan,